All right, let's get right into it. Today, we're deconstructing a pretty dramatic argument, one that claims the entire global silver market is teetering on the edge of a major crisis. And we're not just talking about price swings here. We're talking about a collision of physics, geopolitics, and incredibly fragile financial markets. A situation the source material calls a perfect storm.
And it all kicks off with just three alleged words from one of the most important industrialists on the planet. This is not good. Now, the claim is this wasn't some off-the-cuff remark. This was a signal, a warning about a very real physical problem, something you can't just engineer your way out of or fix with a new government policy.
And yeah, 170%. That's a number that gets your attention. But here's the thing. The analysis we're digging into today says that massive price surge, it's not the actual story. It's just a symptom. Think of it like a fever spike, a clear sign that something much, much deeper is wrong with the system. And that's what we're going to unpack. Okay, so what's really behind this incredibly urgent warning? Well, according to the source material, it's not just one single thing you can point to. Nope. It's a convergence, a perfect alignment of several powerful forces, and they are all barreling towards one very specific date on the calendar. And that date is January 1st, 2026. Mark it down, because that's the day a huge policy change out of China is scheduled to go live. And the argument we're examining claims this isn't just some minor tweak. It's a move that could completely redraw the global map for silver supply practically overnight. Okay, let's dig in. To really understand the pressure cooker that's building here, you have to go back to basics. I'm talking about the actual physics of silver, because according to this whole thesis, that's where this story really starts. You see, this isn't just some fancy marketing slogan. It's a fundamental law of physics. It's a measurable property of the universe. The core assertion here is simple. You cannot build the high-tech future we're all talking about without silver, period. There just isn't a substitute that works at scale. And once you start looking, you see this dependency everywhere. It's in the drive units of your EV. It's in the guts of the AI data centers. It's in the satellites circling the globe. And here's the kicker. The argument is that every big leap forward in technology is actually making us more dependent on silver, not less. And this chart, wow, this really lays out the core problem in black and white. For 5 years straight, we as a planet have used more physical silver than we've been able to pull out of the ground. This isn't just a one-off bad year, a temporary blip. The source calls this a persistent structural deficit. It's baked into the system. And this, right here, is such a critical point to grasp. There's no easy replacement. And get this, here's the real paradox. The argument is that as our tech gets better and more efficient, like with these new advanced solar panels, it actually requires more silver per unit, not less. So our own progress is making the problem worse, just compounding that deficit year after year. So that's the physical demand side of the equation. Now let's pivot to the second massive force in this perfect storm, geopolitics. Because there's a specific policy change on the horizon that could act like a giant control valve on the world's silver supply. We're talking about China's new silver export framework. Now, on the surface, you might just see this as, boring administrative red tape. But the argument being put forward is that this is anything but boring. It's a calculated, strategic move that could have massive global consequences. So, how does it work? Well, the source breaks it down like this. The new rules have these incredibly high bars for production and credit. We're talking huge numbers. And what that does is it basically freezes out all the smaller, independent refiners. They just can't compete. The result? Control of silver exports gets centralized into the hands of just a few massive, state-aligned companies. The analysis uses a pretty powerful phrase to describe this. It calls it weaponizing the periodic table. The whole game is changing. It's no longer just about influencing the price. This policy, it's argued, gives Beijing the power to literally decide who gets silver, and maybe more importantly, who doesn't. It's a pivot from purely economic power to direct control over a physical resource. And for a manufacturer, for a company like Tesla, this changes everything. The whole equation gets flipped on its head. Suddenly, your biggest worry isn't how much will silver cost next quarter. Your biggest worry becomes, can I even get it? It's a shift from a cost problem to a continuity problem. The risk of your entire production line just stop.
So you have this immense physical pressure, right? And you've got this geopolitical chokehold. Now, here's where it gets really interesting, because both of those forces are apparently smashing head-on into the financial market for silver. And that market, well, it's built on a completely different set of rules. And to show you just how fragile that financial system is, the source points to one absolutely staggering number, 350 to 1. Think about that. For every single ounce of real physical silver sitting in a vault ready for delivery, there are supposedly over 350 paper claims, futures contracts, ETFs, you name it, all pointing to that same ounce. The leverage is just immense. This insane level of leverage has apparently triggered something the source calls a silent bank run. This isn't people lining up outside the bank, right? It's much quieter. It's the big players, the industrial users and sovereign funds, steadily pulling their physical metal out of the vaults because they're losing faith that the paper promises are any good. They want the real thing. And you can actually see the stress fractures showing up in the price data. There's this tale of two markets. In the West, you have the futures price, which is all about paper contracts. But then you look at the Shanghai Exchange, which is much more about physical delivery. And guess what? It's been consistently trading at a huge premium, sometimes up to $10 an ounce higher. That's a massive disconnect between the paper price and the price for the actual metal. Okay, so let's pull all these threads together. You've got a structural physical deficit. You've got a new layer of geopolitical control. And you've got a paper market under incredible stress. When you combine all that, the source material makes a very, very provocative argument about the inevitable conclusion, and it all boils down to this one fundamental question. Is what we're seeing just another speculative bubble, a temporary frenzy, or are we at the very beginning of a permanent structural repricing of silver, one that's based not on hype, but on cold, hard, physical reality? To back this up, the analysis points to history, specifically the gold to silver ratio. For literally thousands of years, that ratio was pretty stable, right around 15 to 1. But today, it's way, way off. It's a major historical anomaly. And the argument is, if that ratio just returned to its historical average, well, that would imply a price for silver that most people today would think is absolutely impossible. So, to sum up the entire argument for repricing, it's this. 1. Supply is getting squeezed from two sides, by geology and by geopolitics. 2. Demand is non-negotiable. Our most important technologies simply can't function without it. 3. The paper markets are fragile and look completely disconnected from that reality. And 4. The smart money, the big institutions, are changing their strategy from suppression to accumulation. And all of this leads to what might be the most critical realization in the entire analysis. We might be heading into a new reality where the price on the screen, the sticker price, becomes almost irrelevant. The only thing that matters is your ability to actually get your hands on the physical metal. The market stops being about price and starts being a scramble for access. Which brings us to the final powerful takeaway from this entire thesis. When a critical resource becomes truly scarce, the price becomes secondary. It's not about what you're willing to pay, it's about whether you can get it at all. In that kind of environment, physical ownership isn't just one option, it's the only thing that matters.